Thank you for joining us for our inaugural MTA podcast. Our guest today is Cynthia A, CMT MFTA. Cynthia was the first American to receive the Masters of Financial Technical Analysis diploma. Cynthia is recognized as probably the leading technical analyst in the energy markets. She has a long history in that particular field, working for Chevron, Chemical Bank, and the Saudi Oil Ministry, finally launching her own firm, Kase and Company, in 1992. She's the author of Trading with the Odds, a book that might be a little difficult to find, but definitely worth the effort for those wanting to learn how to trade like a pro. Cynthia trades and consults out of Santa Fe, New Mexico, and welcome, Cynthia.
Thank you very much.
I'm wondering if you can give us some insight into the energy markets that we see about all over the news right now.
Yes, we'll talk a little bit about crude oil and natural gas. I do want to mention to the audience that there's a little bit of an echo on my end. You can't hear it. So if I seem to pause strangely every once in a while, it's because of the echo. Crude oil this morning, this is June 29, approximately 10:30 or so Eastern Time. Over the weekend, we write a forecast, and we called the crude oil market down a little bit more to test at least 68.40 and potentially 67. And it went to 68.36 this morning within 4 cents of our number, but failed to go down to 67. What's been happening in crude is historically, of course, the market went up to historic highs, came way off, went up to the mid-70s and traded off down to the mid-60s from there. Specifically on the August contract, the intermediate swing low is 66.37. And from that point onward, which was about a week or so ago, the market has traded in what one might call an expanding wedge. It's kind of like a flag, but the support and resistance lines are diverging just a little bit, and that 68.36 was a support level. So the key here is that crude oil came off from its intermediate swing high of 73 and change, about $10, and well, more like 8, and has been caught in this corrective mode. So corrections are always choppy, geometric corrections are always a forecaster's nightmare because it's always easy to call a trending market. It's always tough to call a breakout. So purely technically, this market has more room to come down. For those of you who are technicians, you have a down move. You have an upward sloping expanding wedge. And so technically, you ought to have a downward break out of that expanding wedge. But the market hasn't been able to break out of it just yet. The upper intersection line of this expanding wedge is about 72.6. And that is our major resistance point for crude. So right now, we're just kind of sitting back and looking at crude oscillate in this expanding wedge, calling it down from a technical standpoint, but whenever you have uncertain geometric patterns like this, the odds are always more balanced than a normal trending market. When I mean in a normal trending market, if you have a trending market, we always assume that the odds it's going to continue to trend unless we get turn signals is 80-20. When you have a geometric pattern like this, and what I mean by geometric pattern are flags, pennants, expanding wedges, flat wedges, these kinds of things. When you have an expanding wedge like this, the odds are more like 60-40. So right now, crude is not a good trading market. And the same is true for nat gas. Any questions so far?
A question I have, Cynthia, is your analysis looks at things a little bit differently than many other traders. Whereas your wedge, your expanding wedge that you show, is that visible on the daily or the weekly charts?
Yeah, let's right now, I was looking at it on a 4,000 tick bar chart. And also, I was looking at it on a 50-cent case bar chart. And for those of you who are unfamiliar with case bars, but for those of you who read my book, back in 1996, I introduced the concept of universal bars, which were true range bars, equal true range bars. And recently, we have, those have been picked up by TradeStation and renamed case bars. So I'm looking primarily intraday. I used to always use tick bars, so I've got a 4,000 tick bar chart up, and I also have a 50-cent range bar chart up. But let's just take a look at the daily. And the pattern isn't as clear on the daily, but it looks more like a flag on the daily. But you can see it on the daily, but it's only a 1 to 5-day pattern. So it's not as clear on the daily.
And I think that highlights part of your analytical techniques is you don't quite do things like most technicians. Is that a fair statement?
Well, I think it would be fair to say that I've never modeled myself on what other people have done. I've always just kind of done my own thing, and to a certain degree, I find that to be helpful, not to get too involved with groupthink, to step back and analyze it my own way. But we do weekly forecasting. So if you're going to do a weekly forecast, every week say what's going to happen the following week or so, you have to look intraday. And our orientation has always been to support traders and hedgers in the energy market as opposed to people doing long-term investing. So we're very focused on what's happening over the next week or so and helping our clients to determine market direction.
And these type of markets are truly different than equity markets, aren't they?
Well, there's a big difference between commodities and equities, in my view. Number one, commodities are much more cyclical. Having 3-month cycles, yearly cycles, as opposed to the stock market, where I guess you could say you have 50-year cycles and 15-year cycles and that sort of thing. But you don't assume that the market's just going to go up. And certainly, commodities are much less influenced by outside events than equities are. For example, even though certain pundits like to think that the oil companies control the oil market, that's really not true. I mean, the oil market's too big for any one entity to really control. Where if you have a certain equity, it could be influenced by the actions of management, what happens with the president or CEO of a company can highly influence that firm. And so commodities are much less susceptible to human random events. And therefore, to me, they're much easier to trade.
Now, you mentioned the pundits, and the pundits were all over CNBC this weekend talking about how natural gas is the natural gas to crude oil ratio is at an all-time high, and therefore natural gas is a screaming buy. Do you agree with that?
No.
Really, I'm surprised. It's not so simple?
The big question is, why isn't crude oil a screaming sell, So you might say that crude oil is very high relative to natural gas, but the major question is gas too low or is crude too high? And what might end up being true is that both could be correct. But certainly, I would, from a technical standpoint, if you look at gas, and I'm going to bring it up on my screen so that you can see it, Mike, is that if you look at this chart right here, we have a geometric pattern in the bottom of the gas market too. And to me, it looks like a flag, as opposed to an expanding wedge like we had on crude. There is a pretty clear bearish flag on the gas. And this is a daily chart. I'm looking at a daily chart. So there's been a bearish flag setting up all the way since the 26th or so of May. Now, there is an alternate interpretation that it could be a coil, which introduces some ambiguity. But in gas, we're still caught in the same dilemma that we are with crude. Is that, but it's a little bit worse because there was an up move, very small, a down move, and then a flag. So it's hard to say whether or not this whole geometric pattern is corrective of the up move or corrective of the down. But the overall, just purely from a technical standpoint, looking at the pattern, you've got to call it down. Nevertheless, gas has held its support line since that May 26th date, so a little over a month. So you could say that there's a lot of tension between crude and gas. But again, the question is, should gas come up or should crude come off? And so normally, we don't look at gas and oil or things to invest in when you say gas is a buy. So we would be looking for a buy signal before we buy, and we certainly don't have a buy signal in gas right now. As a matter of fact, our trading system would be cautiously short here. So we don't tend to buy when the market is going down. We buy when the market's going up. On gas, that said, technically we don't have that much more room to go to the downside before we would fulfill technical targets. The major technical targets for August gas is 342. The low's 352. So all we need from gas is for it to break to the downside, hit that 342, and theoretically we could say that the down move's over. And at that point, if 342 would hold, we would think it would make sense to buy it. The other, certainly as a short-term play, if you got a buy signal, we of course would buy it, but I'm looking at a price somewhere in the range of about 420, the midpoint of the coil, that to see the prices come up above there and stay there before I would consider buying it.
Now, you mentioned hedging quite a bit in these markets, and over the past few weeks, I believe the company's name is CAN Energy, the largest nat gas producer in North America, forward hedged a large amount of their production. Is that a bullish or bearish signal when we see large producers hedging their forward production?
Well, I think you have to figure out why they're hedging. I think that it would be a mistake for most natural gas producers who were just selling based purely on price to hedge forward here. And we're in a market where the high was over $15 not that long ago. So it seems to me a little bit strange to be hedging. The forward curve is about 550-ish, a little bit better than that. But we don't know why they're hedging. Are they hedging because they borrowed money and it's a bank covenant? Are they hedging for price? Why are they hedging? So I don't think you can read too much into it.
So the complexities of this market, again, are even more different than equities, where insider selling can occur for a variety of reasons. We just don't know what's in their mind. They may just be looking to invest in pipeline projects because they think interest rates are low right now.
Well, yeah, I mean, the way that the exploration and production business works is a lot of times companies will borrow money in order to either buy a field or finance production. And the key is that many of the bank covenants require them to hedge regardless of the price environment. Now, right here, if any producer asked me, told me they wanted to hedge, I would certainly recommend puts, not selling forward. Not at 550.
Okay.
That's not to say for a short-term play, they wouldn't make a little money on it, but in the medium to longer term, I'd be a little bit concerned about just being net short at 550.
Now, part of your analysis, the title of your book again was Trading with the Odds, I believe. And
Right.
you bring a lot of unique aspects to analysis, such as odds, Monte Carlo simulation, value at risk.
Right.
Do you
Right.
consider these to be standard tools for technicians?
Well, let's go through the first one. Monte Carlo analysis
Okay.
is, I have a practice in risk management and hedging, as you said, and so this is kind of borrowed from the quant side of the business. So I wouldn't consider Monte Carlo analysis a standard tool that other technicians use. Nevertheless, it's a very valuable tool as a forecaster. Because what Monte Carlo analysis can tell you is what the probability is under a variety of scenarios of a certain price taking place. So if I'm calling for a price, let's just pick a number, $3.67 in net gas. I can look at, through a Monte Carlo analysis, what the probability of meeting that price in, let's say, a 10-day window is. And if the probability is less than 5%, I might want to rethink my call to that number. Or if the probability is 95%, I might think, well, the technical analysis is confirmed by this purely statistical method. What were the other methods that you mentioned besides Monte Carlo?
You use value at risk also, I noticed.
Yeah, well, value at risk kind of flows out of the Monte Carlo analysis. In other words, if the market's at 4, and under a certain scenario, there's a 95% probability of prices being no higher than 6, then you can say that at the 5% confidence level, you have a $2 risk. So it all kind of relates to each other.
Which kind of helps with position sizing? If you know your value at risk?
I mainly use it in my forecasting as far as the technical analysis is concerned. Hedgers look at value at risk to see what their risk is of not hedging versus the risk of hedging.
Okay. So I guess we're running out of time, so to sum up, what we can say is that your analysis factors in almost anything you think that can help make money?
Yeah, basically we use what I call case wave analysis, which is my kind of modification of Elliott wave. That's the key. That's the main focus of my work is case wave analysis with Fibonacci extensions and retracements, along with geometric patterns, candlestick patterns, divergence. What I consider pretty traditional technical analysis. And our focus is 1 to 2 weeks out when we do our forecast. And just to sum up, in the energy markets right now today, I wouldn't consider good trading markets. Both nat gas and crude are caught in corrective patterns. I think the bias is down, but whenever you have geometric patterns, it's not a real clear call. And so if I were trading energy, I would either be trading very, very short term, just a little up and down moves day to day, or just sitting on the sidelines until we have a breakout.
And wait for the trend?
Yeah, wait for a trend to materialize in whatever time frame you're trading. But as I said, we just don't have a really good trading market right here.
Okay, and you had mentioned that some of your tools, at least case bars, are available on TradeStation?
Correct.
Can traders find out more about any other platforms, or does TradeStation have any other tools available?
Well, 2 things to say. We have I have trading software called Statware, which is currently is available on NinjaTrader, TradeStation, Aspen Graphics, CQG, eSignal. Probably leaving 1 or 2 out, but anybody can go to our website, casestatware.com, and take a look at where our statware is available. We have a giveaway indicator called Case Pivot, which draws in automatic pivot points with waves and labels. And that's available at no charge on most of the platforms I just mentioned. And we're currently in conversation with a major institutional charting platform to have our case bars available on that, along with an automated divergence identification system.
Once these tools get out there, do you think they'll lose their effectiveness?
No. No, it's just like saying, technical analysis loses its effectiveness. I believe in the 80-20 rule. 80% of the people 20% of the people make 80% of the money. And that's because 20% of the people do 80% of the work. People just don't want to, a lot of people just don't put in the time, the effort to really learn how to do a good rigorous forecast, how to use indicators to trade. And so I think that the human race, and I don't say this in a negative way, but just the truth of the matter is that there's only a small minority of people who are willing to put in the work. Once you get to a certain IQ, what makes the difference between one smart person and another smart person is just how hard you work. And I think you're never going to have the majority of people working hard enough to make these tools ineffective.
And I think that's a great way to sum up this call and your style. I think if folks wanted to put time in and study how you do it, they could come close to duplicating your success.
Well, I mean, I have a protege, for lack of a better word, Dean Rogers, who runs my day-to-day business operation, and he actually now writes the majority of our forecasts. We consult with each other about what the forecast is, and then he writes the forecast, and then I edit it. So he's been with me now for almost 10 years, but he has certainly, throughout that time, been able to learn to forecast pretty much as well as I have done. And when you're learning, you might make some mistakes in judgment as you go along, especially at highs or lows when the market's turning. It's a little bit tougher. But over time, given the technology, I think a person with the innate ability to learn it, if they put in the time and effort, can do so.
Well, thank you so much for that encouragement, and we're going to have to end this call now. Thank you again for struggling through our technical difficulties.
You're welcome.
And I hope you'll come back once we get all of our echo problems fixed.
That sounds good.
Thank you.
You're welcome.